Welcome to the International Center at the University of Michigan's U.S. Federal Income Tax webinar. The University of Michigan's International Center provides its F&J visa holders with free access to the user-friendly income tax form preparation software called Syntax. While Syntax does not require that its users have an in-depth understanding of the U.S. income tax process before they can successfully prepare their tax forms, we have designed this webinar for those F&J visa holders who wish to know more about the U.S. income tax process and how it applies to them. Please do not mistake the following information for tax advice. We will now begin with Part 1 of our program. Thank you. Welcome to Part 1 of the Federal Guide to U.S. Income Tax for F&J visa holders. In Part 1, I will provide you with some background information on the U.S. taxation process. I will also discuss tax residency classifications as well as income tax rates and the types of income which you are taxed. First, I will start by providing some information on the U.S. taxation process. The U.S. Tax Authority is known as the Internal Revenue Service, or the IRS. The IRS divides income into two groups for taxation purposes, specifically earned and unearned income. Earned income is income paid for the performance of personal services. It includes, but is not limited to, wages, salary, tips, and professional fees. It also includes scholarship and fellowship funds conditioned on the performance of services. Unearned income is income not related to the performance of personal services, for example, investment-type income like dividends. Earned income and unearned income together make up one's gross income. The IRS calculates one's tax obligation based upon one's gross income. The IRS also divides foreign nationals into two groups for taxation purposes: resident and non-resident aliens. The IRS taxes resident alien income like U.S. citizen income, but treats non-resident alien income differently. U.S. citizen and resident alien earned income is taxed using a process called withholding. The unearned income of these individuals is not subject to withholding. In contrast, both the unearned and earned income of non-resident aliens is subject to withholding. What is withholding? A withholding is a percentage of income deducted by the payer from the payee's income and forwarded to the IRS as prepaid tax. Tax collected via withholding may only be a portion of the total tax an individual owes. This is because one may still owe tax on unearned income. Moreover, because circumstances in the taxpayer's life can change significantly within a year, and/or a withholding could be calculated incorrectly, it is necessary for all individuals who earn income to file a tax return at the beginning of the following year. By filing a return, one can make the necessary income adjustments. Here is a quick illustration of the income withholding process for employees. First, taxes are withheld from an employee's wages prior to receipt. Then, the employer forwards these payments to the IRS. At the beginning of the new year, the IRS reports the total withholding to employees in the form of a W-2. The employee then reports the amount withheld in addition to the other income the employee received that year on his or her tax return. I will now talk about residency classifications for tax purposes. The U.S. federal government taxes foreign nationals according to their tax residency status. Residency for tax purposes is defined differently than residency for immigration purposes. According to the IRS, a foreign national is a resident for tax purposes if she or he is a legal permanent resident under the Immigration and Nationality Act, or if she or he was physically present in the U.S. for the amount of time required by the substantial presence test. If the foreign national does not fall within either of these two categories, she or he is a non-resident alien for tax purposes. Most students and scholars and their dependents qualify for a special exception to the substantial presence test. I will first explain this special exception, and then I will explain how to apply the substantial presence test. Students and scholars in F or J status receive special treatment under U.S. tax law. Individuals in these immigration categories automatically qualify for non-resident alien status for a specific period of time. It is not until after this time frame has passed that they must apply the substantial presence test and determine if they are resident aliens for tax purposes. How long does this special exception apply? All students holding F1 or J1 visas are automatically considered non-resident aliens as long as they have not been in the U.S. as an exempt student or scholar for more than any part of any 5 calendar years in their lifetime. All scholars in J1 status are automatically non-resident aliens as long as they have not been in the U.S. as an exempt student or scholar for more than any part of 2 of the 6 preceding calendar years. Although the number of years a student qualifies for automatic residency is different than the number of years a scholar qualifies for automatic non-residency, time previously spent as an exempt scholar counts as automatic non-residency time for an individual who is now a student, and vice versa. Remember, though, that a scholar need only count back 6 years. The IRS rule that exempts F1 and J1 students and scholars from the substantial presence test also applies in the same way to their F and J dependents. Also, F and J dependents should count time spent in the U.S. in F1 or J1 status, and F1 and J1 students and scholars should count time spent as an F or J dependent when calculating their automatic exemption timeframe. In order to claim automatic non-residency status, the IRS requires that F and J visa holders file Form 8843. This form must be filed not only by the F1 or J1 visa holder, but it must also be filed by each F and J dependent, so each F2 or J2. And this form must be filed regardless of whether one needs to file a tax return or not. If you remain in the U.S. after your automatic non-residency period ends, you will then need to apply the substantial presence test to determine if you are a resident alien for tax purposes. The IRS considers one to be substantially present for the current tax year, in our case 2010, if you were physically present in the U.S. for at least 31 days in the current tax year 2010, and you are physically present in the U.S. for 183 or more days during the 3-year period that includes the current tax year and the 2 years immediately preceding the current tax year. For example, if you were filing for the 2010 tax year, this means you look at 2010, 2009, and 2008. You will count each day you were present in 2010, 1/3 of the days you were present in 2009, and 1/6 of the days you were present in 2008. If you are a resident and a non-resident alien within the same tax year, you are in dual status. The manner in which the IRS treats individuals in this status is complex, and we will not go into it further here. If you believe that you are in dual status and you have additional questions, you should contact the tax professional for advice. You can also look in IRS Publication 519, pages 8 through 10, available online at www.irs.gov. What is the residency election based on marriage? Well, If a non-resident is married to a resident alien or U.S. citizen, the couple can make an election to file a joint return. This means that the non-resident alien spouse will be considered a resident alien for federal income tax purposes. The resident alien rules will then apply to him or her. This can only occur if the spouse is a resident or U.S. citizen before the end of the tax year. Both are treated as resident filers then for the entire tax year. For more details, consult Publication 519, pages 10 and 11 on the IRS website. I will now discuss what types of income are subject to taxation for foreign nationals. How does one know what income types are taxed by the U.S. federal government? Well, this depends in part on whether you are a resident or a non-resident alien. The U.S. IRS treats these two groups differently. Resident aliens are taxed on income sourced from anywhere in the world, their worldwide income. Non-resident aliens are taxed only on their U.S. source income. How does one know whether their income is U.S. source income? Well, this varies by income type. Here are some examples. Interest is considered U.S. source income if it is owed by a U.S. corporation or a U.S. resident. Dividends are U.S. source income if they are paid by a U.S. corporation. Wages are U.S. source income if the services for which the wages are paid are performed in the United States. Scholarship and fellowship funds are considered U.S. source income if the payer is a U.S. resident. Now, the payer may not be the same individual or institution that distributes the money. Also note that international organizations that fall under the International Organization Immunities Act are considered foreign income payers. Real property is U.S. source income if it is located in the United States. Personal property is U.S. source income if the tax home of the taxpayer is located in the U.S. And the definition of tax home can be found in Publication 519 on the IRS website. What U.S. source income is considered tax exempt? In some cases, income that meets the IRS definition for U.S. source income, as presented in the previous slide, has been explicitly determined to be non-taxable income by the IRS. This includes U.S. bank deposit and portfolio interest, and by the way, bank deposit interest need not be reported unless you're a Canadian non-resident alien, compensation or wages paid to non-resident aliens in F or J status by a foreign employer, scholarship or fellowship funds intended for qualified education expenses where the recipient is a degree candidate attending an eligible institution. For scholarship and fellowship funds, how do you know whether you are a degree candidate? Well, to qualify as a degree candidate, an individual must be attending an institution that is accredited and authorized to provide a program offering all the credits needed to obtain a bachelor's degree or higher, or a training program that will prepare a student for gainful employment in a recognized occupation. Really, the University of Michigan's F1 and J1 students are considered degree candidates. J1 scholars, however, are not degree candidates. Now I will clarify what qualified education expenses mean in relation to scholarship and fellowship funds. Scholarship and fellowship funds for degree candidates still may not be tax exempt or may only be partially exempt if the money is not intended for qualified education expenses. Specifically, qualified education expenses means that it must be for tuition and fees required for enrollment or course-related expenses such as books, fees, and supplies required of all students attending the course. Additionally, scholarship and fellowship funds conditioned on the recipient performing a service in exchange are treated like wages, and they do not count as qualified education expenses. For example, the salaries that are provided to GSIs, GSRAs, or GSSAs at the University of Michigan. Qualified tuition reductions for graduate students at the University of Michigan are tax exempt if the graduate student is performing research or teaching activities for the University of Michigan. So, for example, GSIs, GSRAs who receive a qualified tuition reduction, as opposed to their salary, the qualified tuition reduction is tax exempt. Some undergraduates who receive qualified tuition reductions will also be tax exempt. For example, if the undergraduate student is a University of Michigan employee. How do you know at what rate your income will be taxed? Income tax rates for resident aliens are the same as they are for U.S. citizens. These rates are graduated rates, and they are determined based on looking in a particular table for your taxable income and filing status. The income tax rate for non-resident aliens depends on whether the income received is effectively connected to a U.S. trade or business. Income that is effectively connected to a U.S. trade or business is taxed at graduated rates, according to taxable income and filing status. So basically as the resident alien income is taxed. However, income that is not effectively connected is taxed at a flat rate of 30%. In some cases, this flat rate can be reduced by tax treaties. How does one know if their income is effectively connected income? Well, effectively connected income is income acquired from engagement in a U.S. trade or business. Whether an individual is engaged in a U.S. trade or business then depends upon the particular activity that individual is engaged in. U.S. source income received in connection with the engagement in a U.S. trade or business is effectively connected income. Really, all you need to know is that students and scholars in F&J status engaging in related activities are engaged in a U.S. trade or business, and therefore related income is effectively connected income. We have now completed part 1 of the webinar. I hope you have found the information helpful. If you would like to learn more about deductions, exemptions, and credits, common tax treaty benefits, and/or the tax withholding process, please move on to webinar part 2. Thank you.